Hey there, Forex enthusiast. I officially welcome you to ADAD, another day, another dollar.
In today's video, we are going to dive into the exciting world of Forex trading. If you're new to Forex or looking to refresh your knowledge, you are in the right place. Let's get started. So today's content is going to be about me, what Forex is, currency pairs, bid and ask price, long and short positions, leverage and risk management, fundamental and technical analysis. So I have summarized everything and I hope that you get the most out of it. About me, I am very thrilled to welcome you to my corner of the internet. I'm not your typical Forex trader. I'm a young stay at home mom on a mission to show that we can conquer the Forex world right now and right from our homes. My journey began with a passion for Forex trading about 4 years ago. Actually, I'm in my fourth year of trading and a desire to contribute to my family's finances while being there for my little one. As a mom, I understand the importance of balance and making the most of every opportunity that comes our way. So with each trade that I take or make, I'm not just trading currencies. I'm trading my way to financial empowerment, financial freedom, or rather general freedom, and setting an example. Join me as I navigate the exciting world of Forex, sharing insights, tips, and a whole lot of encouragement. When I'm not analyzing the markets or creating content, you'll find me immersed in family time, whipping up delicious meals, or maybe stealing a quiet moment for myself with a good book and a cup of coffee or tea. So, whether you are a fellow stay at home mom, a curious trader, or just looking to learn something new, you are in the right place. Subscribe, hit that notification bell, and let's embark on this exciting journey together. What is Forex? Forex, short for foreign exchange, refers to the global marketplace where currencies are traded against each other. It's the largest and most liquid financial market in the world. The primary purpose of forex trading is to exchange one currency for another with the aim of profiting from the changes in exchange rates between them. In simpler terms, imagine you're planning a trip to a foreign country and you need to exchange your local currency for the currency of that country. The exchange rate at which you make this transaction is determined by the forex market. The forex market operates 24 hours a day, 5 days a week, due to the different time zones of major financial centers across the world. Currency pairs. Currency pairs in forex trading are combinations of two different currencies that are traded against each other. They are used to represent the relative value of one currency against another in the foreign exchange market. Each currency pair consists of a base currency and a quote currency. For example, in the currency pair Euro USD, the euro is the base currency and the USD is the quote currency. The exchange rate of a currency pair tells you how much of the quote currency is needed to buy 1 unit of the base currency. Currency pairs are categorized into three main types. 1. Major pairs. These are the most traded and widely recognized currency pairs in the forex market. They include the most stable and economically influential currencies such as the US dollar, the euro, the Japanese yen, British pound, and the Swiss franc. 2. Minor pairs or cross-currency pairs. These pairs do not include the US dollar as their base or quote currency. Examples include Euro GBP, RGPY, and GBP GPY. 3. Exotic pairs. Exotic pairs involve one major currency and one currency from an emerging or smaller economy. These pairs are less commonly traded and can be more volatile due to the economic conditions of the country involved. Examples include USD Singapore dollar and Euro Turkish lira. Bid and ask price. The bid and ask price are essential concepts in the forex market that indicate the prices at which traders can buy or sell a currency pair. They represent the two sides of a trading transaction and are crucial for understanding how the forex market operates. Bid price. The bid price is the price at which the market is willing to buy a specific currency pair from you. In other words, it's the price at which you can sell the base currency and receive the quote currency. The bid price is always lower than the ask price. Ask price. The ask price is the price at which the market is willing to sell a specific currency pair to you. It's the price at which you can buy the base currency by paying with the quote currency. The ask price is always higher than the bid price. The difference between the bid price and the ask price is known as the spread. The spread is essentially the cost of the trade and represents the broker's profit. A narrower spread is generally more favorable for traders as it means less cost when entering or exiting a trade. Long and short positions. Long and short are terms used in forex trading to describe the directional position a trader takes on a currency pair. These terms indicate whether a trader expects the value of the base currency to rise or fall relative to the quote currency. In a long position, you are buying the base currency and selling the quote currency. You profit if the exchange rate rises, allowing you to sell the base currency for more of the quote currency than you initially paid. Short position. Going short means selling a currency pair with the expectation that its value will decrease over time. In a short position, you are selling the base currency and buying the quote currency. You profit if the exchange rate falls, allowing you to buy back the base currency for fewer units of the quote currency that you initially sold it for. Leverage and risk management. Leverage and risk management are crucial concepts in forex trading that go hand in hand. They play a significant role in determining the level of risk and potential rewards associated with the trading positions. Leverage. Leverage is a borrowing mechanism offered by brokers that allows traders to control a larger position with a smaller amount of capital. It magnifies both potential profits and potential losses. Risk management. Risk management involves strategy to protect your capital and limit potential losses. One common risk management practice is setting a stop loss order. This is a predefined price level at which a trade will automatically close if the market moves against you. It helps prevent larger losses. Another practice is diversification. Instead of putting all your capital into a single trade, diversify across different currency pairs to reduce the impact of a loss. Determine a fixed percentage of your trading capital that you're willing to risk on each trade. Risk management strategies such as setting stop loss orders and practicing proper position sizing are key to protecting your trading capital and maintaining a sustainable trading approach. Always prioritize risk management to ensure a responsible and disciplined trading experience. Fundamental and technical analysis. Fundamental analysis involves studying economic indicators, central bank policies, and geopolitical events. Technical analysis focuses on charts, patterns, and historical price data to predict future prices. Traders often use a combination of both fundamental and technical analysis to make informed decisions. It's important to understand both approaches and how they can complement each other in your trading strategy. So there you have it, a brief overview of forex trading basics. Remember, forex trading requires a combination of knowledge, skill, and discipline, which we will actually look at later in my other videos. If you are new to this, take your time to learn and practice on demo accounts before trading with real money. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more content. Thanks for watching and happy trading!